Hello, everybody, and a warm welcome here to our next webinar today. The 16th of February 2018, 7 o'clock p.m., usual time, but unusual day. Today it's Friday, one day later as usual, but that is only because of my holidays and I need enough days for preparation and all the other stuff when you come back from holidays. A warm welcome in the name of JSD as well. And my name, Stefan Friedrichowski, as always, for those types of webinars. Today was a topic, correlation of Forex pairs. And it will even a little bit more than just a correlation of Forex pairs. We can talk additionally about correlation at all between Euro, US dollar, DAX, and VTE or Brent, whatever. So everything is possible. And that will be the topic of today's webinar. You see already my email address here on the first slide. You can get in touch with me directly. Just use that email. And the slides of today, they are already uploaded, so you can download them via the GoToWebinar control panel as usual. But even later, just send me an email and I make sure so that you get everything what you want here. A few of us might know that last time when we have had a webinar, I said more or less goodbye for going on a holiday. And just give me 2 minutes here to say something about that. I have been in Cambodia and just want to share with you one video. It's just crossing there, and I took my cell phone and recorded that video, and it tells you a little bit about the people there, the people in Cambodia. So let me try to start it, and I hope that it will stream here as well. It's less than a minute, and I will talk during that. And the title of that video could be Order and Chaos in Cambodia. And what is amazing is how things are working there. You see, everything just works. Nobody has really to stop. Nearly nobody has to put his leg on the ground. And even cars do not destroy the overall picture here. So it just works. And talking about that a little bit more from a mathematical standpoint, it's something like a near field order. That means everybody is looking to the next neighbors, and out of looking to the next neighbors, there is no anymore any chaos. People do exactly the right things, and without having traffic jam or any accident. It was really amazing to be there, and it was a wonderful time. Much more warm than here, so it's really warmer there, above 30 degrees all the days, and at night about 20. Great time. So, but anyhow, we go on with the webinar, but I can recommend going to Cambodia for your next vacation. Wonderful people and delicious food. Oh yeah. We talk about correlation, but before doing that in detail, I've always to show that risk disclaimer, I have to mention that whatever you learn here, you do later for your own trading activities. It's totally on your own. I think that's self-explaining and has to be shown at least once per webinar. Anyhow, in detail, what are the topics of today? I will start with a little bit about the motivation, why to deal with correlation and why that's important. That we have a correlation always in mind when we trade. Maybe when we develop trading strategies which are more or less automated and automatically executed, but especially it's quite important if you trade discretionary. few of us may ask, hey, but what is discretionary trading? It's just simple. Whenever you look to a chart and you come to conclusions, I go long euro, US dollar, that is a discretionary decision, and that's a discretionary trading. Even if you look to fundamental data of a specific company or a specific region, that is discretionary as well. You do your decision not by pure statistic or pure math. You do it simply by your own and by your own considerations. And now it comes especially important to look to correlations, because you might open several trades, but that later. When I personally talk about correlation, I want to define it a little bit more clearly, and even not only to really define what it means and what kind of numbers we get when we talk about correlation. I want to show how they are developed and what they really mean, and that we will do a little bit by an Excel sheet just to visualize what it really means when we talk about correlation and anti-correlation or even no correlation. We do some examples, some investigations on two double pairs, I would call them. So it's 2 times forex pairs against each other, and then we look more at detail what does it mean if we see high correlation, low correlation, even anti-correlation. When we want to use those things, practically there's something in addition which you can find at JFD, because there's a simple and very good add-on, and that is an add-on for MT4, and you can have it for MT5 as well, simply by downloading the JFD webpage, and then you get a lot of information automatically, exactly in that way you might need them, the right time frames, the right history, and the right symbols you are interested in. And then that helps a lot. I will show how to install and how to use it, and that we will do a little bit more practically, just by some examples, and see how we deal with correlation and how can we use it and how can we avoid special trades if we look carefully to correlation itself. Okay, the motivation looking to correlation, there's especially one starting point, and in most cases, and I think I speak for everybody here in that webinar, in most cases you open not a single trade, you open several trades, or you have running trades. Not a single one, you have several trades simultaneously. Of course, there might be exceptions, like people who definitely say, I have always at maximum one trade running, and I wait until that trade is coming to an end, and then I decide whether to open a new one or even not. But in most cases, we talk about several trades simultaneously. And that's not really restricted to the FX market. It might incorporate other indices or other underlyings like indices, stocks, commodities, whatever. The question, or one of the motivation behind to have those trades simultaneously, is quite simple. We want to diversify our trading activities, which is good. Diversification is a good thing, of course. But if we trade correlated underlyings, we do not diversify. If we trade in a similar way, or I just in brackets name it here, same trades. You will later see what I mean here. Or to be a little bit more specific, if I have two underlyings which are highly correlated, then I should not open two long trades or two short trades in one long in the one and the other long in the other underlying. That I do mean with same. But in case of we are totally anti-correlated, so reverse, then it would mean the one in long, then the other one short, then it's the same trade. So that's behind that. In general, we try to diversify our trades through simultaneously opened several trades. But in case of correlation, it does simply mean we increase our risk and nothing else. So we have to deal with it, correlation. And finally, we start with a chart, but finally, you want to do it mathematically because we need some better description for that. But that everybody really knows when I talk here about correlation and anti-correlation and something like that. Let me open two charts here, and I go for Euro US dollar, one chart, and I will prepare those two charts a little bit. Just give me a few seconds here. And then we look for another chart, which will be the British pound US dollar, or some people call it the so-called cable. But anyhow, for me, it's just an underlying, just a symbol. And let's have a look to those two underlyings simultaneously. So let me prepare the charts that we have them simultaneously opened here, and that we see what I really mean when we talk about correlation. So here's the other one, and let me bring it to the same scale, and then I think you will more or less immediately realize what I mean. So we have two underlyings. And if you look to the chart, in this case, right now it's an M15 chart, you see more or less two identical charts. So for sure, what we have here, and mathematically speaking, we have so-called time series. So we have two series of simply data, and the one is British pound US dollar, and the other one, in our case, Euro US dollar. And you see two charts, and they more or less look identical. And that's exactly what we mean with highly correlated markets. Visually, it's obvious, and you may need a very close look to find some deviations, and there are deviations, of course. For example, here in the final end, it doesn't look really exactly the same, or but there are other parts. Yeah, look for this one here from the day before yesterday that jumped down, and a few minutes later, or 1 hour later, jumped up again. Everything looks the same. And now think about you opened a trade, and let me even try to do it in a positive way, meaning it might be profitable. So maybe at that point in time, we decided to go long in British pound US dollar, and later it turned out good decision, nice. But let's think a few minutes later, we said, okay, I go long in Euro US dollar as well. Of course, in this case, it would be nice because both trades could have been ended with a profit here. But what does it really mean here to open another trade long on Euro US dollar? It simply means you double your risk. You even might have doubled your initial lot size for the British pound trade, and then you are done as well. So there's no real difference if you compare doubling the volume for the British pound US dollar trade, or a few minutes later open a second trade long Euro US dollar. It's just the same. So that is exactly not diversification. It's just doubling your risk with the next trade. And this is a good example of what we try to avoid when we really take into account correlation. What's obvious here, that those two markets, those two underlyings are highly correlated is not that obvious always. And yeah, maybe you don't want to use thousands of charts and analyze them visually. It's much better to do it mathematically, because then you get all the numbers just in on a short run. So it's much quicker, much faster. A short remark here on, let me change time frame. I go for H1 and here for H1 as well. And you see, okay, in most cases, we still find the more or less same behavior. We have some deviations here in the middle part, but only very temporarily. And let me go for D1 here and for D1 here as well. And still you find quite positive correlations. Once again, there are deviations. And we are not talking about 100% correlation. But later we will see that, especially if we look for British pound US dollar and euro US dollar under the perspective of correlation, they are most of the time highly correlated. Or the other conclusion out of that is, if that is the case, that those two markets, both having the US dollar as a last name in the Forex pair name, it simply means that the euro British pound is more or less boring. Because this picture here, that those two markets are that highly correlated, is only possible in this special case because both Forex pairs end on US dollar, is only possible if the Forex pair, which is created by the two first names here, euro, British pound, is more or less boring. If that would really wiggle around quite huge, then we would not get that highly correlated final picture. That's another conclusion, simply out of that highly correlated market of Forex pairs in this case. So motivation, I think, I hope, is obvious. And now everything has to deal with how can we manage that mathematically, that what we find out here visually to have those two highly correlated markets, how can we define that mathematically, and how can we really talk in numbers and not only say high, medium, and something like that. And the definition of correlation is finally simply a formula, and you can find that formula on Wikipedia, for example. If you type correlation and then space Wikipedia, then you will find the exact mathematical definition. What I want to point out here is only that there's a number. And when we talk about time series, and we do it practically in a minute here in Excel, correlation is just a number, and that number is simply between -1 and +1. That's all. Or other describe it as -100% up to +100%. But of course, this is identically. And what does it mean to have that number between -1 and +1? +1 means it's a perfect correlation. So if we have a number of 1, then we know for sure we have found a perfect correlation of those two time series, or later our two underlyings or markets or whatever. But we can even have the reverse. We might have a -1 as well for that correlation number. And the -1 means there's a perfect anti-correlation. What does it mean? Anti-correlation. In terms of looking to our markets, it means the one goes up and the other goes down. So they are doing just the opposite to each other. And that is an anti-correlation. And of course, we can have a number of close to 0 or 0 itself. And then we have that point that we talk about two uncorrelated markets. And now it's getting interesting. Think about you have first trade opened. You have a trade opened, British pound, US dollar, as before. And now you want to open a second trade. And you're not sure which chart you should investigate next in order to identify maybe a potential good trade. Looking for another forex pair which is to the British pound US dollar, because there you have already a trade open. Looking for another underlying which is more or less uncorrelated to your first one, the British pound US dollar. So if you found a correlation of close to zero for that other underlying, then we know if you open a trade in that underlying, then we open a trade in an uncorrelated market compared to the one we have already an open and running trade. And that is something which helps us, because then we know that we are not doing what has been my usual example, like British pound US dollar going long there and euro US dollar going long there as well. So that is totally uncorrelated, and that is interesting to identify those markets which have a correlation of zero to each other. So, but what does it mean here? If you get those kind of numbers, and let's do that in practice. Later we come to pictures like this one here. But in order to demonstrate what it really means talking about correlation, let me do in a couple of minutes here just an example on a white paper, on a white Excel sheet, because then you see exactly what I mean if we talk about having high numbers for correlation, low numbers, or even numbers which are minus. Let me create one time series just by my own here, just by some fantasy numbers. You may think this represents some underlyings. I have no idea what underlyings that should be with those numbers. But anyhow, it's only a matter of having some numbers in order to ask ourselves, is something uncorrelated or not? And just to have a few numbers here. So now we have two time series. One time series, let's call them A, and the other one maybe B, that are our two underlyings. Of course, we can visualize like our two charts with cable and euro US dollar. We can visualize those two time series like here, and now you see already, doesn't look that bad about correlation. And the good thing is now we can measure, and that is later exactly what that tool is doing. It's exactly doing what we can do in Excel as well, and that is something like like this here. That once again I have to do it this and that, and now we get it. So now we have the number and the correlation of those two time series in this case, and it's good that you practice your eye with some examples by your own, just to see what it means. 0.88 is now the correlation between red and blue line, and so they are already quite correlated. And let me try to make that correlation even a little bit better. Let me go here down for this one, and you see just moving the one number to zero here increases already the correlation. And then let's change another number here, maybe that one to 5. Correlation goes up a little bit more, and now it's getting up even more, and you see exactly what happens. Correlation is increasing, and of course we see it by our eye as well. But now we have an impression of what does it mean, 0.8, 0.7, and so on and so forth. So that formula, Corel, directly gives us the correlation number between -1 and +1. And let me create an example here with anti-correlation as well. Let me turn this one exactly to the opposite, and then it's immediately getting in the range of more and more being uncorrelated. You see the number goes more and more to the minus, and this one doesn't change the picture that much. Maybe you see now it's getting more and more uncorrelated. Numbers are getting higher and higher here, so the absolute numbers. And now you see that is something which is typically anti-correlated. Yeah, and then if we have numbers which are really more or less random here, then we will finally have something which is more in the region of uncorrelated. Let me try to create something like that. It's sometimes not that easy to really get something uncorrelated. And maybe we go here for 10. And now we have something which is more or less uncorrelated. You see there's no common pattern, and that means things are uncorrelated or both to each other that are a little bit like white noise. But that is something we want to have, because if we have one trade open in one underlying and we can open another good trade out of chart analysis or whatever we have done to derive the second trade, and we know that the second one is uncorrelated to the first one, then we have something which is really diversification. So you see how it works. It's just a visual impression here, I know, but now let's go practice with some real number and not fantasy number like we started here. And what I want to show you here is just two examples. One will be Australian dollar, Canadian dollar against the euro, US dollar, and we will see that we have everything: uncorrelated, correlated, anti-correlated, everything. And once again, I want to do it in now with real numbers for a long time period, for the one we have had at the very beginning. So cable and euro, US dollar. And once again, we will derive the conclusion that in most cases, most time, the correlation is quite positive. So how can you do something like that by your own? Of course, you need the data, and talk about that several times, how to get those data. Those here are D1 data directly from the web page. Stock, a little bit strange written, STOO, and then Q.com, and then you can have those data. If you are doing analysis like this one here by your own, please make sure that the two numbers are really of the same date or same time. Sometimes if you download data and then you copy and paste them in one Excel sheet, and you will realize, oh, maybe for one time series, for one underlying, there's one day missing, and then it comes out of order. It's not anymore sorted. So make sure that they are really of the same date, all the data, and then you can do analysis like this. We can do it here, for example, visually. Once again, we have 18 years data for those two underlyings, and already by eye we can recognize, hey, yeah, there are phases of good correlation, but look here at the very end, for example, we have totally anti-correlation. The one goes up, the other goes down. It's very, very end, it's getting similar. And what we do now here is simply exactly the same than in last Excel spreadsheet. You see, we have here the formula correl, and what I did here, I calculate the correlation for the last 200, in this case, days, because we have data on a daily base. So for the last 200 data entries, so it's a correlation 200, which is measured right now here. And to see how that looks, I have a chart here, and you see everything happens. Totally, there are phases with good correlation. There are phases, especially at the very end, with anti-correlation, now slightly recovering. But the good thing is now we have it mathematically. And to have two trades open for Australian dollar, Canadian dollar, and euro, US dollar, two trades open simultaneously would have only been rare examples. So when we are close to zero, I mentioned, then it's a good time to have those two trades simultaneously. If we have good reasons for those trades at all, we do it by chart analysis, whatever kind of technique you are using. But in most cases, it goes to the extremes quite fast. But we have to bear in mind that we are looking here for 18 years price data. How's the picture? So you see everything is possible here, correlation, anti-correlation, and we have to be at the right point in time to do the right decisions. But we now know how to do it. But let me quickly go through the other example, cable against euro US dollar here. And that is this example. And you see most cases quite good correlation, and that we see already visually. But now let's look to that mathematically, and you see what happens. There have been only a few points in time where that high correlated markets have been interrupted. And the one is a Brexit decision, and the other one I cannot remember really well. It's around financial crisis when we hit the zero line here to the direction of anti-correlation. But in most of the 18 years, those two underlyings are highly correlated. So we can know how to derive something like that. Let me look to the to a question here. The question is, for day trading, what time frame and how many candles do you recommend? So what I typically do is indeed I analyze the last 200 candles. So if I look to the D1 chart, it would mean going back 200 candles. Maybe 100 is already okay, but in that order. The other thing is the one here mentioned for day trading. So for day trading, you might enter your trades on H1, or you might enter your trades on H4 base. So that would be, for me, the right time frame for day trading, not directly to the D1 chart, but it would be H1 or H4. And once again, I would look for the last 100 to 200 in order to identify those numbers for correlation and anti-correlation and even uncorrelated. So that would be my personal guideline for that. Good. So we know how to investigate, and even for those who are interested in automated and trading strategies, having those numbers, then you can start your work on getting trading strategies which directly use that kind of correlation, anti-correlation, and even no correlation. So, but now we still keep in mind here that we are doing things discretionary, and let's look how we can use a special tool for that. It makes life much easier because then we don't have to look in detail in Excel or any other kind of way to calculate the correlation. So the good thing is that JFD is offering a so-called add-on. And that add-on is not only a single one, it's even a package of several add-ons I will show in a minute. And you will find them on the JFD webpage. Since I show the webpage itself later, you even might make a screenshot or whatever here for that link, or you go for the slides which you can download. those and what is to be done, download and start. I will show also that. Formally, those add-ons are expert advisors, but not for automatic trading. Those expert advisors just generate numbers, in this case our correlation matrix, and that is exactly what we want to use. So using the tool means take that expert advisor, throw that one on a chart, and then you get the correlation matrix. So here are the several steps for that purpose. And the first one is you visit exactly that web page, and then you can download here those add-ons. And just that you know, there are really a couple of one: trade terminal, market depth, mini terminal, and so on. And for example, another one which is really smart, and it's called Smart Lines. The good thing there is you draw a line in the chart, and later that line will be your stop loss for an ongoing trade, which is really cool. So it's not a trailing stop, it's something like an expected behavior for stop loss for your ongoing trade. And therefore it's called Smart Line. Then you have possibilities to connect Excel with the MT4 and stealth order, something a little bit weird, but a good thing if you want to hide your stop loss and take profit settings, sentiment trading, and finally we go for correlation, and even more finally we have the correlation metrics. And that is exactly what we want to use here, because then we get those numbers and those answers we are interested in order to open the next trade after we have opened the first one. So simply downloading, and then what are the next steps? You have it downloaded. The download is simply a file, an executable file. So it will look like this one here. So everything you have to do is JFD MT4 apps, double click on that, and then it will ask you on which of your MT4 instances. Even in my case, you see I have 6 open instances here of MT4. Should those add-ons be installed for everyone, or no, only for a single one? So you can decide your own. And then after having done this, then it will look like this one here. So you have all those add-ons under experts. So the English version would be not Experten, it would be experts. And then you have all those here after you have restarted your MT4, or you have actualized the expert advisors of your running MT4. So just a restart is doing its job. And what comes next? Very simple. We need a chart. We need just a chart, an open chart here, and I don't care about that chart really, but the only thing I have to do is I go for the correlation metrics and throw that expert advisor here, and then after a few seconds, then it opens up here my correlation metrics. So that is an individual window. You can minimize, you can do whatever you want with that window. It acts like an individual program. And now we have all those numbers of interest. In my case, I have here, let's say my interest is in the correlation of 7 different euro pairs. So euro pairs means in my case euro, Japanese yen, euro, US dollar, euro, British pound, and so on and so forth. And I get that kind of information. But let's start how to use it. Or let's first let me show you what else you can do and how things have to be done here. So you can change the selection of underlyings. So here you can add new symbols to your correlation matrix. Like, for example, let me even add something totally different, like the DAX. And in order to do that, please make sure that one thing you have done before. A symbol you want to add in your personal correlation matrix has to be present in the market watch as well. So only those which are visible in the market watch can be added to the correlation matrix. Only those, and then you can add a new symbol here to the correlation matrix, and then we have even the DAX within those forex pairs. And now the question is, let's assume you have an open trade in euro, New Zealand dollar, maybe a long trade, whatever. And now, before just crossing all the different charts, we want to answer the question, what pair could be a good candidate to be the next trading opportunity, which is more or less uncorrelated to our first trade? Answer: on H1 base, Euro, Swiss franc. That would be the first one. And the second one, in this case here, would be Euro, Australian dollar. And then comes the DAX in that order. Because that still doesn't mean that I say, okay, we have to open the next trade in Euro, Swiss franc. No. That would be the next chart I should investigate and look whether I can identify a good trading opportunity in whatever direction, long or short. The good thing is we know that compared to our already running trade, Euro, New Zealand dollar, this potential trade on Euro, Swiss franc would be uncorrelated. And that means that we are really diversifying our trading account or trading portfolio. And that's exactly what we've tried to achieve. You see other examples which should be avoided, like this one here, nearly black. To have a trade in Euro Canadian dollar and simultaneously a trade in Euro US dollar should be avoided, because those two are totally uncorrelated. Totally correlated, sorry. That was really the wrong word here. So, and the good thing is we have everything just in a second, just by having a look here to those numbers. Of course, if you look to a specific correlation, it should have to do with time frame you are interested in. So if you want to trade on M5 base, then you don't care about the correlation on a D1 base. So you should be on the same time frame here. But of course, we can change the time frame, and if we would be interested in D1, okay, here are the numbers. So it's quite easy to do that. It's quite easy to add your own personal symbols, or do here only those symbols which you are really interested in. You don't have to put everything here. Maybe Euro, Czech, how do I call it, Czech francs, is maybe not your favorite currency pair, or Euro Singapore dollars. Then don't look to those. Just look to those you are really interested in, and then you can derive your conclusions. Let me highlight here something else, how you can use the correlation matrix additionally. So first thing has been to identify something which is more or less uncorrelated to an already ongoing trade. The other thing here is, especially if you look for symbols or underlyings, like in my case here, and you see that I have everything with Euro first name and other names as a second name. Now it's getting interesting to look for the one with the highest minus. Why? Let's first look which number has the highest minus. Oh, and on D1 it doesn't look that good. Let me change time frame to H1. Even here I have more luck, but we have nearly nothing uncorrelated. I think the highest or lowest minus number, is here, minus 52. And why is it interesting? What does it mean? We have Euro New Zealand dollar and Euro US dollar, which are highly uncorrelated. Highly, at least the highest number, mathematically correct, it would be the lowest number, but you know what I mean. We have the most negative number here. Well, why is that interesting? Euro New Zealand dollar and Euro US dollar are a little bit anti-correlated, or a little more anti-correlated. And now we get a chance. That means that we can expect, at least for the history, that New Zealand dollar, US dollar has had high movements, so big movements. That's a very trendy underlying that we can derive just by looking to that number, minus 52. Because those two forex pairs, which have the same first name, in this case euro, are highly anti-correlated, and that means we have good trendy behavior exactly in the two which are remaining, and that is New Zealand dollar, US dollar. Let me check. So I need symbols, a new symbol here because it hasn't been on the chart. New Zealand dollar, US dollar, and now we go for a chart here, and we go for the same time frame. Let me look to the time frame. It has been H1, where we are there. And you see, there have been really huge movements in that underlying New Zealand dollar, US dollar. Huge movements are a little bit more easy to trade, at least if they are not just only wiggling around like this one here. But for a couple of hours, we have really trendy behavior, and that you find an indication for that just by looking to the correlation metrics. So the good thing is you don't have to analyze 30 different charts. The only thing you have to analyze is that correlation matrix, and then you know already what you can do. And now we have already two opportunities. One, to identify the next trade, which would really diversify my portfolio. And the second chance is to look for highly anti-correlated forex pairs in case we are really looking to something like Euro XXX in what I have done here. Only then that kind of consideration is 100% correct. If everything is a little bit mixed with first name and last name, then it's getting a little bit more complicated because sometimes you need some high numbers. But anyhow, you know what I mean, and you know how to deal with that. Just by that correlation matrix, which helps you for your trading activities. And even if you consider correlations between gold, DAX, and oil, no problem. Any underlying can be incorporated into that correlation matrix here. So that's really a very nice tool, and it's free. So maybe it can only be used on JFD accounts. I'm not sure. I have not figured out and not tried, but I assume at least that there's a restriction. But even opening a demo account will do the job that you get the tool up and running, and then you can use that kind of information. The one, I repeat myself, identifying the next trade which would be uncorrelated, meaning diversification, or even to identify trendy behaviors for forex pairs. That's already good stuff, but there's even one step more, and that I just briefly want to share with you, because even for me it's running now since 2 days, so it's really fresh, because I'm on the way to use correlation for automatic strategies as well. Let me describe a little bit what I'm doing here, so that we have a clear picture on that. What I do here is exactly what I did with my correlation matrix. If you look to what kind of symbols I'm using here, they are exactly the same 7 symbols. Euro always in first name, and then another one as a second name. But not in this case, I'm not creating those decisions like in my example with New Zealand dollar, US dollar. I just really trade only those 7 symbols, but with the same question behind. And the same question behind means I want to trade those which are uncorrelated to each other in order to have diversified trading activity. So the maximum open trades is here 3. So out of the 7, maximum 3 are traded. And right now we have trades running in Euro Australian dollar, Euro Japanese yen, and Euro New Zealand dollar. And only if one of those 3 trades is closed, I will ask again the question, which one should I add, which is mostly uncorrelated to the already 2 running ones. And then I open a trade for the third one once again. So it's always looking for the opportunities of opening trades in uncorrelated markets. So that's the basic idea behind. Still, you have to answer the question long or short. But what I will know before really answering that question long or short is I trade the next one which is uncorrelated to the previous. And that's what I want to achieve here. So it's really fresh, and you see account results are not already telling you anything. So a few trades are done. Let me report on that at a later stage again. And of course, I have done investigations how and those trades have to be opened, and that's implemented in those expert advisors. Thanks to the help of Peter Milner, who is always coding those EAs, and he has done that job during my holidays. That's a little bit unfair, but sometimes it happens like that. And now we are in the test phase for this one. Okay, let me summarize what we have learned and done here today. So we know now correlation is really a valuable tool in order to identify suitable markets. And what I mean here is that if we have a lot of trades simultaneously, those trades should be at least a little bit be uncorrelated. Otherwise, it's just an increase of risk. And we want to diversify our portfolio, our trading account, and therefore we have to consider correlation as one methodology in order to get it quantitative. That we don't trade in highly correlated markets, and we simply increase our risk. The other thing is that I have introduced here a little bit about that JFD add-on package, and we just used one add-on out of that, and that is correlation matrix. It's easy to use. It's easy to get it up and running. You can change settings, you can change underlyings, timeframes, and so on. And the good thing is it's just free. That tool helps you to get those answers on the first 2 questions, and help you to really diversify your trading activities. And I think at least up to now, everybody knows how those numbers of correlation between -1 and +1 have to be interpreted, and how to do it. Okay, that's already for now. And in 2 weeks, it's less than 2 weeks, it's only 1.5 weeks, we do the next webinar. Then it goes around candlestick formations. And the funny thing is, we use, once again, correlation in order to identify candlestick formations. You will see how that works. It's not that complicated, but indeed we use correlation for candlestick formation and the identification of candlestick formations. But the even more interesting question is, what kind of candlestick formations are really tradable and profitable? You can read hundreds of textbooks about candlestick formations and how to trade them. But the really valid and important question is, does it work? And in which case? And then how? And that will be answered in the next webinar about candlestick formations. You find on the JFD webpage as always. Okay, that's for now. Thank you very much for your interest here, and see you again, hopefully, in nearly 2 weeks. And yeah, have a good evening. Bye-bye.